Hey guys, this is Bob Iaccino. Thanks again for being here. Welcome to Nadex spreads. This is listed as Class 2 because we did an intro to Nadex spreads that you can find on Nadex's website archived. This is how Nadex spreads are constructed. Mike Arnold is here with me as always. We are the co-founders of Path Trading Partners, and we'll go into that a little bit more in a minute. But first, as always, a quick risk statement. This presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your own financial conditions. Past performance is not indicative of future results. So I mentioned that I was going to get started on who we are. Path Trading Partners is a proprietary trading and education firm. And our mission was to form a trading firm that educates, supports, and backs traders, meaning provides seed capital, to traders who are committed to probabilities, discipline, and long-term trading success. And this is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. We're a firm that believes in long-term success in trading, covering time frames dictated to us by products, markets, and price action. I always like to go into what we mean by that. Is oftentimes people will say, are you a day trader? And yeah, I might take a trade for a day. Are you high-frequency traders? I might trade a lot in a given day. Some days I don't trade at all, and some days I take longer-term trades depending on the product. You just have to remember that the market dictates to us what we do. We're not so arrogant as to think that we know what to impart upon the market. We take the trades that the market gives us. Mike Arnold is a 24-plus year market veteran. He's been teaching traders online and in person for 10-plus years. He was and still is a strategy and development consultant to multiple hedge funds. I've mentioned this before. Hedge funds will create a model and they call in Mike to tell them what's wrong with it. He's essentially hired to break their models for them. He's a former options market maker on multiple exchanges. He's traded in Chicago, New York, Switzerland, and Canada, and he's the current head of technology and trading system development for Path Trading Partners. That's me up in the corner there. I wear a lot of pink shirts. I've been around for about 24 years in commodities, futures, and the FX markets. Traded equities for myself as well, equities and equity options. I've been teaching and mentoring traders both online and live since about 2002. I have been a proprietary trader, a fund of hedge funds principal, and a member of the investment committee at that fund of hedge funds, which is where I think I benefit you guys. To date, I've taught and mentored over 5,000 students, and I continue to appear on all of the major networks. If you recognize me, that's obviously me and Becky Quick, but I continue to do 5 to 10 appearances per month. I've done about 700 interviews over my guest analyst part of my career. Let's get into the meat of what we're going to talk about here. This is intro to Nadex spreads. And this part of the class is focusing on how Nadex spreads are different than trading the underlying. We will begin to look at risk graphs for the underlying and Nadex spreads. And this is just a brief introduction. We'll get into the advanced concepts of how the spreads are actually constructed later in this class. But we have to start with an introduction to the products, obviously. We also have to teach you about risk graphs. So before we get started learning about Nadex spreads, we need to look at the concept of risk graphs. So risk graphs have two axes, a horizontal axis representing the price of the underlying, and a vertical axis representing the gain or loss of the trader's position. Very important to remember that. Okay, the vertical axis represents the gain or loss of the position that you would be in, represented by the graph. So here's an example. Again, you have the vertical axis here, and then you have the horizontal axis there. So these graphs will go in different directions depending on whether you're long or short once we actually get into them. So the horizontal axis, again, represents the price of the underlying. Now, this is not a loss in the underlying because your position is not in the underlying. When you go to the left here under lower, that just means the price of the underlying is headed lower. Okay, if you're in a Nadex spread, you are not in an underlying position. You're in an option based off of the movement of the underlying and other factors that we also teach. So if the price is moving to the left on the horizontal axis, that just means the price of the underlying is going lower. If it's moving to the right, it means the price of the underlying is going higher. The intersection in the middle is the entry price. The vertical axis represents whether the position you're in, okay, the Nadex spread that you're in, is either in a loss or a gain situation. Again, the entry price represented by the intersection, and loss would be on the lower part of the vertical axis, and the gain would be on the upper part. So let's take a look at a long underlying risk graph. The maximum gain of a long underlying is unlimited, and the maximum loss is limited to the underlying going to zero. Now remember, in this particular one, we're talking about the underlying, not a Nadex spread. Okay, so if you were long the S&P 500, the maximum gain is unlimited. Theoretically, the S&P 500 can go to 50,000 or 100,000. It doesn't have a limit to where it can go. The maximum loss is limited to every single company in the S&P 500 being worth zero. Okay, so the maximum loss is limited to the underlying going to zero. In a short underlying, again, this is representative. If the underlying is going lower, the gain is here, represented in the top left. That's the gain of the position. Okay, price of the underlying, gain or loss of the position. If the underlying is going higher, then the position goes into loss. Okay? The maximum gain is limited to the underlying going zero in a short underlying position. And the maximum loss is unlimited because, again, if you're short the S&P 500, it can theoretically go to 100,000. Okay? 200,000, 300,000. That's theoretically. So this is just to show you what the actual underlying position would look like in a short. Then let's go back to a long. Again, if the underlying goes higher, your position goes into a gain. If the underlying goes lower, your position goes into a loss in a long underlying. Opposite in a short underlying. Fairly simple concept. You're not expected to get it right yet, but as we go through this, you'll see a little bit more in the option positions why these particular graphs matter. Now let's go over some Nadex spread terms because we're going to need to know them for the graphs. The floor price is also referred to as a lower strike price. It's the lower boundary of the spread. The ceiling price is also referred to as the upper strike price. It is the upper boundary of the spread. Long means you're a buyer of the spread. You're wanting the price to increase. The maximum gain limited by the ceiling of the Nadex spread, and the maximum loss is contained by the floor. If you're short, that equals being a seller of the spread. You're wanting the price to decrease. Your maximum gain is limited by the floor, and your maximum loss is contained by the ceiling. Remember, the floor and the ceiling represent the upper and lower boundaries of the spread itself. So let's take a look at what a long Nadex spread would look like. As we mentioned, the maximum gain is limited to the ceiling price minus the entry price, and the maximum loss is limited to the entry price minus the floor price. For example, if a trader trades the US 500 spread 1900 to 1930, okay, 1900 being the floor, 1930 being the ceiling, and enters long at 1915, then the maximum loss is 15 and the maximum gain is 15. Again, the gain is the ceiling price minus the entry price, and the loss is the entry price minus the floor price. And this is what the long Nadex spread graph would look like. So if you were long, here's the entry price right here in the middle. Okay? As the underlying goes down, your position goes into a loss and then stops at the floor price. Same thing on the opposite side. As the underlying goes higher, it's represented in here, it goes up to the ceiling price and then goes flat because you have a cap on your gains as well. Let's take a look at the other side of that. A short Nadex spread, the maximum gain is limited to the entry price minus the floor price, and a maximum loss is limited to the ceiling price minus the entry price. For example, if a trader trades the US 500 spread 1900 to 1930 and enters short this time, at the same price, 19.15. Then the maximum gain is 15 and the maximum loss is 15. So here's the entry price. Remember, you're short. So when you're short, you want the underlying to go lower. Your price goes into profitability on the left-hand side of the vertical axis and stops when the underlying reaches the floor price. Same thing, not in real time obviously, but for the example of this graph, this is all representing at expiration, okay? And then the same thing on the other side. If you're short the spread and the spread goes up, the underlying goes up, then your position goes into loss, on the loss side here, and then stops at the ceiling price. Pretty simple concept as to how to read these. I'm going to turn it over to Mike now to go into some of the other graphs in detail.
All right, thanks, Bob. Thanks, everyone, for joining us. So we're going to keep elaborating on this concept. In order to do that, we have to take a more in-depth look at some options principles. This part of the class is focusing on how Nadex spreads are constructed. All right, we're going to cover some basic ideas of trading options. They're constructed from options, so we have to cover some option concepts. This is necessary to understand how an option spread works and thereby understand how a Nadex spread works. And this stuff is a foundation it's going to provide you so in future webinars where we go over how time decay affects the spreads, as Bob said. We're looking at these risk graphs as if it were expiration, but these graphs do not really look that way prior to expiration. So in order to understand how, like, volatility, how time affect your Nadex spreads, you first have to understand some of the basics about options and that these spreads are constructed from options. We're going to cover the option stuff very quickly. Do not worry if you do not understand everything. You can watch this webinar a few times. You can go. We're trying to show you where this stuff comes from and not give you a huge in-depth options course because, again, we're here to understand this in terms of Nadex spreads and then how you can more thoroughly understand the way these Nadex spreads behave over time with changes in implied volatility and therefore become a better trader of them. And this is just the initial part in the series. So Bob went over the underlying graphs and how if you were long or short those, how they looked, and they briefly showed how the Nadex spreads for if you're long or short them, those risk graphs look. Let's go into just some risk graphs of options. So this is a long call risk graph, and it's similar to purchasing the underlying except it has limited risk. If you were going to buy a call option, you were going to go long a call option. It doesn't matter on what, a stock, a futures contract in the foreign exchange market, and you're going to do a long call, you would be paying premium, okay, which would be the maximum loss. If you were to hold it to expiration, that could be the maximum you could lose. So if you paid out whatever your fee was, whatever the premium was, and the underlying went against you, the most you could lose is what you paid for it. If it goes in your direction for a long call, you'd want it to be the underlying to be going up. All right, after it's gone up enough to cover the premium that you paid, you'd start making money. That's why it shifts from red to green. All right, so above this horizontal axis, once it's the underline's moved enough to cover the premium you've paid, you start making money. So it's a limited risk position, and the maximum gain is theoretically unlimited. Let's look at going short a call. Short a call meaning you're selling that call that we just looked at. If you're selling that call we just looked at, you will collect the premium. All right? So a short call is similar to shorting the underlying except it has limited reward and unlimited risk. So in this case, you're selling this, you're collecting the premium. If the underlying goes down, well, this call, the person who you sold it to, their call will expire worthless, so you get to keep that premium. However, if the underlying goes up, you at some point after it's gone up enough past the amount of premium you collected, you start losing money theoretically to infinity. So it's a limited reward, unlimited risk. You could also, in the options market, go long a put, which means you want the underlying to go down, and you have to pay for that right to do it. So you're paying out premium. It's the opposite of the call. A long call, you're paying premium, and you want the market to go up or the underlying to go up. A long put, you're paying the premium, and you want the market to go down. So this has limited risk. If the market, you thought the market was going to go down, however, that market goes higher, the most you can lose is the premium you paid if you held it to expiration. So that's the maximum loss. The maximum gain is, some people say it's unlimited. Yeah, well, it's limited just by the whatever you're trading going to zero. So if it was a stock and the stock was at 100 when you put it on and it went to zero, you'd make the difference between the 100 and the zero. People say it's unlimited. It's really not unlimited, but we're not going to quibble about that in this webinar. So this would be a risk graph for a long put. Underlying goes down, you're long the put. After it covers the premium amount that you paid, you start making money. Opposite of that is the short put, where you collect the premium. Now you want the underlying to stay where you put it on or go higher, so you keep that premium you collected. However, if the underlying starts going down the way the person who was long that put wanted it to go, and they're making the money, you would start losing money. After it goes down enough to eat through all that premium you collected, you'd start losing that money. Theoretically, unlimited risk. Well, it's just based off the underlying, again, going to zero. So that would be, you could get a very big loss if you go short a put and the underlying goes lower. All right, well, why are we going through all this? Because you're going to start understanding how assembling these calls or puts and going long one and short one is actually what a Nadex spread is. Before we get into that, I'm going to give you a little insider secret. I was an options market maker, and so this is the way we really look at it. Insider secret that few traders know, except for advanced option traders and our options market makers, is a long call can equal a long put, and a short call can equal a short put. And you might say, well, they're going two different directions. Like a long call, you want the underlying to go up. A long put, you want the underlying to go down. So how can they be equal? Essentially, the only thing you need to realize is if you're a long or short premium. So either if we're long a call, we can make that into a long put, or if we're long a put, we can make that into a long call because we're long premium, meaning we've paid out of our pocket to get the premium. Remember, for a long call, if you look, long call, we had to pay out, and we want the market to go up. Well, for a long put, we had to pay out, we want the market to go down. So in either case, we've paid something out of our pocket to put that position on. The exact opposite is true for the short call and short put. We've collected on either side of those. So a call can be converted to a put, and a put can be converted to a call. And let me show you how that's done. And options market makers will do this to adjust their positions, hedge their positions. Let's say I was long a call. I paid out, as I said, I paid some premium. If I then go short the underlying and I add these graphs together, it really results in a long put. How does that happen? Well, if the underlying goes down, I'm short it, I'm making money. I've capped my loss to the premium paid. So this loss is capped. I stop losing money on this if it keeps going down, but I'm making it on the underlying. That's like a long put. However, if the underlying goes up, I'm making it on the call, I'm losing it on the short, and they offset. So actually this upsloping cancels out this downsloping into a flat line of the premium I initially paid to put the long call on. So I can convert a long call to a long put by going short the underlying. I can also convert a long put to a long call. I can also, if I'm short a call, that means I collected premium. I put some premium in my pocket, but I don't want this underlying to go up. Let's say I change my mind. I say, hey, the underlying might be going up, but I already have a short call on. If I go long the underlying, it really now equals a short put. So I've converted that short call into a short put. Simply because in this case, I collected premium, which is the same premium that I would have collected with the short put. I went long the underlying. So where the underlying's going higher, I'm making money on the long underlying. I'm losing it on the short call. They offset. If it goes down, I'm losing it on the long underlying. This is capped for the short call. That's how this turns into a unlimited loss. So a short call can be converted to a short put, and a short put can be converted to a short call. All you have to remember is you have to do something in the underlying, and you can't convert a short call to a long call without unwinding the position and reestablishing a position. You can't convert a short put to a long put, but you can convert the shorts to the opposite, like a short call to a short put and a long call to a long put. Now, let's get into spreads. A spread is an option position that involves having both a long and a short option position of the same type on the same underlying. The primary types of spreads are vertical spreads, horizontal spreads, and diagonal spreads. Why are they called verticals, horizontals, and diagonals? Well, vertical spread is used to describe the purchase of one option and the sale of another option where both are of the same type and same expiration but have different strike prices. So these are what it would look like if you went, if you were going to go on the CBOE and look at OEX options, which are based off the S&P 100. So if I want to buy this option and sell this one, you can see they're in a vertical configuration. They're stacked on top of each other. Okay? That's why it's called a vertical spread. A horizontal spread is a strategy where the shorter term expiration option is traded against the longer term expiration option having the same strike price but different expirations. This is also called a calendar spread. So in this way, let me go back real quick. In this vertical spread, we're just looking at 1 month. So let's say these were all September options, or pretend they're all May options, because that's the month we're in. Well, here we're looking at calendar spread. Now we're looking at September options and October options. So if I wanted to go long a September, and they're going to be of the same strike, so this would be the 865 strike. So I'm going long this one, and I'm going short this one. You can see how they're in a horizontal configuration now. That's why they're called a horizontal spread. A diagonal spread is just combining the vertical and horizontal spread. So it's doing different strikes on different months, and you can see now how it's got a vertical configuration. All right. All Nadex spreads are really vertical spreads, which we'll prove out in a second. So if I'm just in the options market and want to put on a vertical debit bull call spread, what that's going to mean is I'm going to go long or buy the lower strike call, and I'm going to go short the upper strike call. So I'm going long, which would be this risk graph on the left here, and it's the lower strike call, which starts to look like this. I'm going short the upper strike call. That's how I get a lower strike and an upper strike. What you'll notice on the call that I went long, I had to pay out to do that. I'm going to have some premium at risk, and at some point that's going to be making money. On the one I went short at, remember this is at a different strike price, at a higher strike price, I'm going to collect premium in here, not as much as the one I went long because this is a higher strike price, and at some point I will start losing money. Well, here's how this really works out. It cost me money to put this on because I had to pay more than I took in from shorting this call, so that's why it's a debit bull call spread. I had to pay out of my pocket. I start making money at some point if it goes up, and then the gains are capped because at some point this upward sloping arrow is offset by this downward sloping arrow, so that cancels out. So you can see on this graph here on the right, at some point the upward sloping arrow is canceled out by the short call downward sloping arrow, and we get this flat section. So that's what a debit bull call spread looks like. And here's what a long Nadex spread looks like. In this example, we have a floor price and a ceiling price. And this presupposes that we put it on in the middle of the spread. So if we put it on in the middle of the spread, the underlying went down against us, we would be losing until it hit the floor price, and our loss would be capped. We can only lose so much. If we put it on in the middle of the spread and the underlying goes higher and we're long it, we get gains up until the ceiling price where it's capped. Very similar to what this one looked like. In the vertical debit bull call spread, we had a lower strike and an upper strike. In a long Nadex spread, if we're long it, we have a floor price and a ceiling price. Why did we get this? We got it by using options. We got it by using going long a call and short a call at a higher strike price. We could also do this with a bear put spread. Okay, so this would be going long an upper strike put and shorting a lower strike put. So we'd be going long an upper strike put, which would be here, short a lower strike put, which would be here. So we'd be making money as it went down. Eventually, that put that we're short would kick in, and the gains would be offset by the losses of that short put. This is what the graph would look like for a vertical debit bear put spread. And we have to pay out to do this because the put that we're going long is more expensive than the put we're going short. That's why it's a debit. We're paying out of our pocket to do it. Well, that pretty much looks like a short Nadex spread. We have a ceiling price and a floor price. If we put it on the middle of the spread, our losses are capped at the ceiling price. Our gains are capped at the floor price. Very similar to the vertical debit put spread. If we put that on theoretically in the middle of these two strike prices, our gains are capped at the lower strike. Our losses are capped at the upper strike. So if the underlying goes higher, we lose money until it gets the upper strike, and then we don't lose anymore. If it goes lower, the underlying goes lower. We gain until it gets to the lower strike, and then we do not lose anymore. Short Nadex spread. Credit spreads. So far we have covered debit vertical spreads. They are debit spreads because they will cost you money to establish the position. If you are trading options directly, you can also put on credit spreads, meaning if you are trading options against futures or options against stocks, you could put on credit spreads also. For example, you can establish a bear call spread and a bull put spread. Those are both credit spreads, and they will credit your account when you put them on if you were to do it in the options market. Since this is not a seminar covering all spread types, the Nadex will not be covering them in this class. All Nadex spreads that you will be putting on are the debit spreads. So it would be a debit bull call spread or a debit bear put spread. So let me just reiterate this point again. All the Nadex spreads are debit spreads because you're paying to put them on, meaning when you establish a position in your account, it will be debited. We are not going to refer to spreads as call or put spreads, since one of the benefits of Nadex spreads is there's just one spread type. You don't have to worry about how they're constructed. I wanted to show you how they're constructed, so now you say, hey, I know they're constructed of options. All right, and if I'm going long that Nadex spread, it would be constructed of call options. If I'm going short that Nadex spread, it would be constructed of put options. You don't have to worry about that anymore. You just have to establish that they are constructed of options. Why do you need to know again that they're constructed of options? Because these Nadex spreads are going to behave in a very similar manner to these debit bull call spreads and debit bear put spreads. Now, if you're long the spread, you generally want the price of the underlying to increase. If you're short the spread, you generally want the price to decrease. Depending on where you put the spread on, there are times where you may want the price to remain flat so you can collect the premium. And that's an advanced concept we will get into in future webinars. The brilliant thing about trading Nadex spreads is that they have simplified the whole spread trading process while keeping all the benefits of the vertical spreads. And there are lots of benefits of these vertical spreads. There's lots of interesting things you can do. You just have to really understand how these spreads behave, which is what we're going to get into in future webinars. But until then, let me just turn it back over to Bob, and he can talk about the long Nadex spreads and the short Nadex spreads.
Thank you, Mike. So again, Mike went over it, and this is essentially a similar situation, a similar graph, where you can see essentially where your max gain, max loss, and then the entry price is. It's a similar way of looking at this particular shape. This particular shape represents the same sort of a risk graph. We're just not showing the two axes. And this is if no premium were involved. So you know here at the floor price, if you enter at the floor price, you're in a max gain situation. If you enter in the center of the spread, you've got basically even max gain and max loss. And then if you enter here at the ceiling price, you've got all max loss and nothing else. This represents no premium, and this again is the shape that you saw in the other risk graphs. As we go into short, it's exactly the same thing. Again, if there were no premiums, this is the perfect shape of the risk graph. You have max loss and max gain at the dead center between the floor and the ceiling price. Max gain if you were to enter a short at the ceiling price, and max loss. The important thing to learn here is to look at the shape of these particular curves represented in the risk graphs and understand that this, just because it's at a lower point, doesn't represent the floor price in these graphs. There's a reason why we show these graphs, and as you go into what actually affects the Nadex spread price moving forward, when you start learning about the Greeks and time decay and volatility, that's where you end up in a situation where you see why these graphs matter. Because this again represents no premium and at expiration. What you'll see in future presentations is actual curves that are representative of this same stiff and structured graph, but are not showing you a particular spread with no premiums involved. So in this class, we learned about the risk graphs of options. We showed how option vertical spreads are constructed, and we examined how Nadex has simplified the construction of spreads. We learned how all Nadex spreads are debit spreads, and we examined different hypothetical entry points for long and short Nadex spreads and looked at the potential gains and losses. The thing that you need to grab from this particular presentation is that Nadex spreads are all debit spreads. They're vertical debit spreads. They are options. You are learning to trade options when you're learning to trade Nadex spreads. Binary options are as well, but they have a slightly different construct. The Nadex spreads are essentially simple and easy vertical debit spreads pre-constructed for you at levels. And there's a lot that you need to know. Trading is not so simple as, well, I think it's going higher, let me do this one. And understanding these particular risk graphs and the construction of these spreads takes that first step for you in order to learn where is the best point to put these particular spreads on, in what conditions should I be looking to put it on above that sort of break-even middle point between the floor and the ceiling, below it, and then even near the ceiling price in the case of a long, or near the floor price in the case of a short. There are situations where you want to put those trades on. So in the next session, we will learn how the underlying relationship to the spread affects the pricing. We'll investigate the concepts of in the money, which is ITM, at the money, which is ATM, and out of the money as related to spreads. And we will examine the intrinsic and extrinsic values, or the inherent versus the premium that a trader is paying to trade a spread. Very important that you go to this next webinar. It'll be the same time next Tuesday if you want to continue and learn the way that the spreads are not only constructed, which we went through here, but then how they're priced and what it means when we're talking about something being in the money, at the money, or out of the money. Again, we always stick around for questions if you have any. In the meantime, if you could follow us on Twitter at @path_trading, like us on Facebook at Path Trading Partners, and then visit our website if you can. Our website is going through some maintenance right now, so if you visit it right now and it isn't working the way that it should, please come back. And please listen to our podcast, The Money Path, which can be found on the website as well. And all of our blog articles as well, the ones we write for ourselves and the ones we write for Nadex, are also on the Path Trading Partners website. So, a couple of questions. What is the quickest way to collect the premium, i.e. what needs to occur? And what is the ideal type of spread to enter in order for this to occur? Before Mike jumps in to answer that, I'm always troubled when I hear what's the quickest way. I mean, sometimes the speed matters for a particular type of setup, and sometimes it doesn't. I always get a little bit troubled when I hear what's the quickest way to get this money. I'm not saying this person's name, and I'm not saying that's what you're trying to imply, but sometimes it's not about speed. It's about, as a matter of fact, all the time, it's not about speed. It's about the highest probability trade, not about how fast can I collect money. He followed up with, it's not greed, I'm just curious. What is the ideal type of spread in enter? I think you should really tune in for the next couple of webinars, or even go look at some of the archived ones that we've done, because there's so much more that goes into it than what is the ideal type of spread. You want to jump in on this, Mike?
Yeah, there's a lot of things, and you're going to have to either watch the archived ones or stay tuned for the next few weeks of these, because there's different market conditions, and there's different places you can put on the spreads at different times to expiration with different volatility conditions. There are market views you can have where the market could be stagnant, where you say, okay, we're coming off high implied volatility, we're going to lower implied volatility, I'm going to put a long spread on at a point where I can collect the premium, which means the time decay works in my favor, and that could be also because implied volatility is coming down. But there's very specific market conditions, and that's why we're first teaching you that these things are options, and then how these spreads will behave based on time changes, based off underlying changes, and based off of implied volatility changes. So you can learn that we're headed into, or we are in this kind of market environment. This would be a good time for me to consider an in-the-money theta capture spread. Versus, okay, we're at these kind of conditions, and this is the time when I want to consider putting the long spread on at the money, because maybe we're into rising volatility conditions and I have a lot of time to expiration, so I don't have a high theta decay yet. So those are all things that you're going to have to learn as we continue to go over these webinars for the next few weeks.
Olympio says, where can I get the tools for the graphics? I'm not sure what you mean, Olympio. If you're talking about PowerPoint tools, or if you're talking about risk graphs, it's more important that you understand the concepts than you are to actually create your own risk graphs. And again, I think your point should be to be in the next few webinars as well, to understand all of these things before you. People tend to want to run off and say, okay, give me a tool, and I want to click here, and I want to figure it out. But yeah, the Greeks, ST, that's right. You have to get involved in the Greeks, and the Greeks do apply to Nadex spreads and Nadex binaries as well. We're going to cover the spreads in the next 3 or 4 webinars. So. Very Greek to me. Is there a website or a book that I can get to look at all the terms and their definitions? Yeah, you can watch our webinars on our website, Dedrick, or you can stick around for the next few, because that's what we're going to be doing. We're going to be covering all the terms and the Greeks and everything, same time next week Tuesday, and then the following week Tuesday, and then the following week after that.
You're going to be learning what I was just meaning with at the money, in the money, out of the money, theta capture, vega, or implied volatility changes. We're going to clearly go through all those terms, not only as they are in the options world as they apply to options, but then specifically how they apply to Nadex products, like the spreads and the binaries.
What else, guys? Anything else? Again, I would talk to anyone who's in this webinar right now to just try and force yourself to slow down. I know it's hard. I know it's really, really hard because you're excited, and some of you may have personal situations where you want to speed up. But you have to understand that the faster you go, the worse it's going to be. And there was a lot of information just in this particular webinar, and you can watch this one again because Nadex will post it in their archives. Check out the new Nadex website, by the way. It's great. But there's going to be a lot of information, especially in the next 3. And you're going to have to go over this information again and again and again. So go slow, watch the recording, watch this recording over and over again. Make sure you understand the way the graphs look, because when Mike goes into the graphs next week, there's going to be some curvature to some of the lines, and if you don't understand where the profitability is and the move in the underlying is, you won't understand the curvature of those particular graphs when he shows you what they look like at different times and things like that. Sounds like training I learned at Optionetics years back. I remember Optionetics. I don't know, I never trained with them. So.
Yeah, because that's how these are constructed. They're based.
And these are options.
Yeah, these are options. So you just can't disassemble the Nadex spread. It's already pre-packaged for you. That's one of the great benefits. Instead of you having to figure out what call to go long, which call to go short, and have that sort of go to the options world and have it quoted out and then put it on. You can just, hey, it's here. I can look up, here's the ceiling, here's the floor I want based off the ones that are available, and here's roughly where I want to put it on. Let me go long it or short it. So you don't have to worry about all that Optionetics stuff.
That's the great thing about Nadex spread is it's, again, packaged for you, created for you. Like Mike said, you don't have to worry about the extras, but you do have to understand options, at least at a base level, to understand where the pricing is going and why it's moving the way it's moving and what the best times to put which spread on is and what the best market conditions to put which spread on is. You're just so much farther ahead if you learn those things than people who just say, I think it's going up, and they pick a spread and put on a long. All right, I'm not seeing any more questions. Anyone else have any? Otherwise, we will turn it back over to Nadex to essentially end this webinar. Your Moneyness and Greeks webinars are truly informative and the key to Nadex. Thank you, Michael, but I don't like to read those nice ones. When will your strategy course be ready? There's some strategy courses on our website already, Eric. What we essentially do on our website is we teach analysis that you then affect in the market by trading either binaries or spreads. But again, if you guys go to our website now, we're undergoing some maintenance, so if you go to our website now and you're not able to get in, please come back because we're just going through some maintenance right now. So we expected it to be kind of on and off for a little bit, and that is exactly what's happening. So, thank you, ST. Thank you, Michael. We will see you guys soon. And I think that is it. All right, guys. Thanks again for being here, and we'll see you guys at the same time next Tuesday. Cheers, everybody. Thanks to Nadex again. Thanks, Mike.